Celsius Holdings, ticker symbol on this one is CELH. This is an energy drink company. It is a $55 stock as of right now. Now I'm doing tremendous on this position. Average cost in the public count is $24.39. We're already at $124,000 on the stock. It's been a tremendous performer for us. It's got a long way to go in regards to this. Whenever you see, a stock that has been performing great, sometimes people think like, oh, it can't do any better. Listen, man, like Celsius used to be a $5 stock, and that had been a big jump for it. Celsius used to be a $20 stock, and that was a big jump, right? Now it's a $55 stock. So, if Celsius goes where I think it's going, like we have a long, long way of upside from here. Now, you got to understand this stock is actually still trading at a monumental discount from where the stock was trading at just last year. At its 2024 highs, this stock got close to $100 a share. Today it's 55. Now, I can make a very strong case for you that this company actually should be valued more where it used to be valued back then, because now we got rid of the bearish narratives around the stock and we have a whole lot of bullish catalysts going for us in the future here, okay? So, first off, we're already PepsiCo made an investment in Celsius a few years ago. Then Celsius had these skyrocketing numbers because PepsiCo basically had distribution all over the place. Well, what happened was then PepsiCo had a little over ordering, and then additionally, like Celsius had these ridiculous comps because PepsiCo basically got Celsius into just about every single store you could possibly want to be in the United States of America, right? PepsiCo has incredible reach, incredible distribution. So what happened is Celsius showed really kind of lame numbers when it comes to revenue for really like the past year. And it was because of that, essentially. You come off those brutal comps and over ordering, it's a double whammy. Now, that's over. That's no longer an issue moving forward, which is phenomenal news for 2026 numbers for Celsius and moving forward after that. Additionally, Celsius now owns Alani Beverage. This is a company they bought very recently here, and they just, acquired them like literally in the past few months. They now have them integrated into the company. Now, Alani, some of you guys might know this, it's been an energy drink brand that has been really, really popping off in, just across the United States of America recently. And so I'm sure a lot of folks know of this brand. Additionally, they just acquired Rockstar Energy. Now, Rockstar Energy, smaller player. From what I understand, it's about a 2% player in the United States of America. Used to actually be really popular, but what happened was PepsiCo bought out Rockstar basically at the beginning of 2020. And PepsiCo paid almost $4 billion for Rockstar. Now, Celsius is getting Rockstar for basically pennies on the dollar. This is like, they almost got to gift it to them. It's ridiculous. Like, they paid hardly, it's insane. Like, the deal that Celsius just did for to get Rockstar brand is unbelievable. And so hopefully Celsius can revive Rockstar. If they can't, it's not a game breaker, for Celsius in any way. It's just only upside, in regards to this Rockstar brand and what Celsius might be able to bring them back to. But basically, these PepsiCo, Coca-Cola, they've tried a lot of energy drink brands over time. They bought different energy drink brands, and they all crashed and failed. Every single one of them. And so Coca-Cola realized, let's just make an investment in somebody. So what Coca-Cola did years ago, a lot of years ago, is they invested into Monster Energy. They own around 20%-ish of Monster. And PepsiCo realized, dude, we're a failure at this. Let's just acquire a part of Celsius. And so PepsiCo's now a big shareholder of Celsius, essentially, okay? Now, additionally, this was something that's massive, and I don't think people understand the ramifications of what this means for growth rates for Celsius moving forward in 2026 specifically. So listen. In that deal, basically, PepsiCo announced that they're now going to distribute Alani. Now, remember what happened with Celsius's numbers when PepsiCo did the distribution deal with them. They went through the roof. So what do you think is going to happen with the Alani numbers in 2026 as PepsiCo distributes those products all over the United States of America? My guess is, remember, Alani's already got incredible growth even without this PepsiCo deal. So now this is like putting a rocket booster behind Alani now at this point in time, right? So what you're going to see is Alani's growth rates skyrocket, Celsius's growth rates skyrocket simultaneously. This is a big, big deal, and that's in the United States and Canada. Now, additionally, if you look at how Alani was distributed prior, it looks like they were basically through a beer network, which is okay, but it's not ideal. It's not ideal, okay? And as somebody that used to work, for Walgreens back in the day and dealt with distribution companies, and as somebody that used to be a manager at QT, Quick Trip back in the day, you really want to have your distribution with Coca-Cola or Pepsi, okay? Just trust me. It's a much better situation, okay? Now, here's the revenue of Celsius, and this is what has transpired over time. Now, this was that come down of the Pepsi over ordering and the distribution, the tough comps and all that stuff, right? Okay, it was so depressing for like a few quarters there. This is where we're back to now at this point in time. And what you're going to see is revenue skyrocket for this company for quite a while. Now, in regards to the energy drink space, is a 3-horse race now at this point in time, a 3-horse race between Red Bull, Monster, in Celsius. Now, if you add up the Celsius market share with Alani, with Rockstar, you're at roughly around a 20% market share or so. And long-term, Celsius might be able to get this to like 25% or somewhere like that. Maybe best case scenario, like 30% market share, which would be incredible if they had that in North America, that sort of market share, right? Now, the thing you got to understand is Red Bull and Monster, right? I just thought Red Bull, it gives you wings. Here's the deal. And this is a problem for Red Bull and Monster. Actually have some pretty big problems going for them, okay? So toward the end of 2022, the co-founder of Red Bull passed away, all right? Now, in his place, they decided to do this weird thing where basically they're going to have 3 CEOs that are kind of on the board of directors to make big decisions, which is I don't know about this. I don't know about this, guys. That doesn't sound like it's going to be good long term. And so Red Bull, I would say, doesn't have the best leadership situation going for them anytime soon. Okay, and I think long term that's going to end up hurting Red Bull significantly. And Celsius has a lot to gain there. Now, additionally, in regards to Monster, there's basically co-CEOs that built this. Basically they acquired this company back in the 90s. And then they started the Monster Energy brand around 2002, and they made it double the size of a Red Bull. And the brand took off, to unbelievable heights. And 2 gentlemen led the company throughout this whole time, Rodney Sachs and Hilton. Well, basically, Rodney Sachs is stepping down from the company, but he is still going to be the chairman of the company. So these guys are kind of at the end of their run in regards to the Monster run, which is a historic beverage run they've been on, right? Now, Hilton's going to continue to run this company, but he's way out of his working prime now at this point in time. He's about 73 years old, from what we understand. Now, keep in mind, your prime as far as a CEO is about 45 to 65. That's the time period when you still have a lot of energy, right? You have experienced a lot in business. You know how to navigate, different situations. You understand this game on a high level. And so Hilton's now well out of his prime. I don't know how much longer he's even going to run Monster. And so somebody's going to have to take it over. Maybe Monster ends up getting sold to Coca-Cola over time. I don't know how they're going to end up. But the moral of the story is here, like the guys that built Red Bull, the guys that built Monster, they're already left or they're on their way out, essentially, right? Meanwhile, John, who's led Celsius over the past number of years, he's built this company into what they've become, right? And he's in the prime of his working career. If I recall, he's 44, 45 years old, just right entering the prime of his career. And so we've got Red Bull and Monster who are going to be, in my opinion, on their back foot for the next 10 plus years. And we've got Celsius with a CEO that's going to be in his prime for the next 10 years. And so I think that is not the best thing if you're Red Bull or Monster, but I think this is very good news for Celsius at this point in time, because remember, Celsius needs to just keep grabbing market share, and market share. Now, when it comes to Celsius, here's the deal. Okay, listen. The whole market cap of the company is around $14 billion, all right? Which is a decent-sized drink company. It looks like it's around the 28th biggest market cap company. But where they're trying to get to is like a Monster-type company. Monster's over a $60 billion market cap. Now, keep in mind, Celsius and Alani, they have so much more of an opportunity. Like the rest of the 2020s is really just around getting those 2 brands around every place you can possibly imagine in North America, right? And then reviving the Rockstar brand. 2030 and past is going to be the international game. Just like for Monster, really, like a lot of their success over the last 10 years has come from international. right? They have a great core, like North American business, but then international's kind of been a great boost to Monster. And so Celsius still has that whole game to play out, folks. So it's going to be a fun next 5-10 years in regards to Celsius. So Celsius, I remain very, very bullish on this company. I think it's still very early days in the build out. I like the way everything's lining up here. I love John, the gentleman that's been leading this company for the last number of years. He's done an amazing job building this from just like a joke little micro cap company into like a serious contender in the drink space, right? Like, we're going to be talking likely someday about this being like a top 10 biggest market cap company when it comes to drink space. At least that's in my opinion, right? Because a lot of these other companies are dead for growth. They're dead for growth. Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. Elf Beauty, ticker symbol on this one is ELF, $138 stock here today. Now, this is a stock, it's performed unbelievable for me, up almost 1,800% in the public count. Cost base on this one, $7.28. Those were shares I acquired back in 2019. Now, you might just think I'm just sitting on these shares that I've had for like 100 years now. No. I've been buying the stock heavily this year across different portfolios. This is one of my bigger positions. I'll show you guys here. For example, this is 1,500 shares. My average price on this one is $59.13. So I've been buying ELF heavily this year. We're already up $118,000 on this. So it really shows my conviction of ELF from back in the day and ELF in current day, like as in 2025, right? Now, here's the deal. Okay, this is what I'm showing you right now is 1000xstocks.com. This is my premium software I use on a day in, day out basis, okay? And this is our charts feature. So we have a ton of different charts on there that can really give you an understanding of where the company's been, where the company's likely going, right? Now we can see when it comes to Celsius's earnings per share, it skyrocketed, and then we went through kind of a nasty down cycle, right? As the company's just kind of focused on growth, acquisitions, road acquisition, which we'll get into in just a moment, all these sorts of things, right? So we're right here. This is where we're at right here. This is where the company's earnings per share is expected to go based upon analyst expectations here, right? We're about to get into an unbelievable revenue cycle that we'll speak more about in just a moment. But additionally, over this next 1 to 2 years, you're going to see the earnings per share of this company skyrocket as well, which is going to be a whole lot of fun. Now, here's a free cash flow of the company recently. Here's a trailing 12-month operating cash flow of the company. Imagine where free cash flow and operating cash flow are 2 years, 3 years out for this company. I mean, the numbers are going to be shocking in regards to this, right? Now, Elf Beauty, the cosmetics company, also has shareholder equity that has been skyrocketing over the years. Phenomenal. Additionally, what I'm showing you now is trailing 12-month revenue of Elf over time, right? It's a growth company. It's a major growth company. And they're about to put it with a turbo booster behind it. You know why? Because they acquired a company named Rhode Beauty. Rhode Beauty, which is a company started by Hailey Bieber. This company just got into Sephora. Now, Sephora, if you didn't know, Sephora is owned by Louis Vuitton, and it's a very popular cosmetic store. Rhode Beauty, for the most part, has only been a brand that really sold like direct to consumer. So the fact that now they're going to scale this out into retail is going to be monumental for them. And I think it's genius that they're going into Sephora. And the reason being is this brand they don't want to be like super high end. They don't want to be like Estee Lauder. At least it doesn't come across that. They don't want to be an Estee Lauder or those sorts of price points, right? And super niche like a Louis Vuitton, because Louis Vuitton sells some makeup and beauty products as well. But they're not trying to go there. But they want to be like a higher end than, let's say, an Elf, which is a great opportunity for them. Right now, you go to their website, like they understand like marketing to the newer generation, whether it be even the millennials, but especially like Gen Z, Gen Alpha, like they just get it. Like you just go to their website and you're like, get it, man. They understand like what's cool, what's not cool, and all those sorts of things, which is big for them. Now, I was looking at some of their products they were highlighting on their page. It's a different price point than what Elf is used to. Like they got this peptide lip trio. Maybe I should use that. Three little tubes here, and it's $56. So that's different price points. Like Elf, a lot of Elf products are like, a lot of $10 and under products for Elf, right? Especially 15 and under. This, you get like this duo here of blush and lip combo, which is $45. So they're at a higher price point than Elf, which could actually help ASP's average selling price for Elf as a whole company in a monumental way. Now, this company is very successful on social media, which shouldn't come as a surprise with Hailey Bieber. And, obviously she's married to Justin Bieber and, networked with all the celebrities you want to be. They all those folks really understand social media on a very high level, right? And so they have 3.7 million followers on Instagram, for instance. Elf has 7.5 million. So considering how small Rode is, that's amazing. And Elf understands, I think, social media better than probably any makeup brand out there in the world. It's incredible, right? Now, the bottom line is with Elf, growth is back. Baby, growth is back for Elf. And this is huge because you understand everybody and their grandma wants to be an Elf when they have the big growth numbers. And they're about to have the big growth numbers again. And so I think you're seeing a pile in regards to the stock. I mean, this stock was $49 just back in April. And it's already at 133. I don't think this pile up into the stock is going to end anytime soon. It won't end, in my opinion, until we see a peak in revenue growth. And I don't know when that peak in revenue growth is. My guess is it's probably 1 to 2 years away. 1 to 2 years we'll probably see. And when I say peak in revenue growth, I don't mean like, the company never grows after that. What I'm talking about is the revenue growth acceleration. Because what you're going to see is a massive acceleration cycle now for Elf and Rode. So my guess is we probably see a peak at that at some point in the next 1 to 2 years. But between now and then, the stock's just going to continue to beast. People are going to be like, oh my gosh, they got the growth again. Like, you got to be in it. Because where else are you going to get that? In the makeup and beauty industry. If you want to invest in any sort of cosmetics related company, where are you going to get big growth? You got one option. It's Elf. That's your only option. Like, look at all the other cosmetics companies and look at there's no other option for you. There's one option, which means there's a pile in of the stock going to be for quite a while. And so the other thing with Elf, right, is this stock still trading at a big discount to where it was back in 24. I mean, this stock peaked well over $210 back in 24. It's 138 today. And so you're going to likely continue to see a pile up. And don't be surprised at all if this stock is $200 plus before you know it. So something to keep in mind there. Elf has a beautiful next 5-10 years ahead of that company. But, in terms of even the short term, as in the next 1 to 2 years, oh my gosh, phenomenal. Okay. Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. Alrighty, next up here, let's react to some Dan Niles video here on the market.
Great to be on, Melissa.
It certainly doesn't seem this way that there is an adoption slowdown when you go through earnings calls, when you hear what companies are saying, but there could be a difference in what they're broadcasting versus what is actually going on in terms of dollars spent. What's your take on this? Because there's always that concern that there's a pull forward, that the expectations were just being bloated to begin with, and that it will catch up with this trade.
Yeah, I think the tough thing is don't confuse what stock prices are doing with what's actually going on fundamentally, because those two things can be completely different for short periods of time. And that's what you have going on right now. You were talking earlier about, the Fed cutting rates starting again that cycle on September 17th.
Oh my goodness, these landscapers are something else. This is the whole situation going on.
Rates starting again that cycle on September 17th, and that's driving these stocks up. But if you listen to what is actually coming out from these companies, it paints a slightly different picture, right? Where, remember, there was an MIT study that came out that 95% of companies weren't seeing any, improvement from their spending on AI. Then you get to company actions, which matter more than these surveys, and you go, all right, Meta, which has been absolutely killing it with their Llama models, now there's talk that they're going to work with either Google or OpenAI to get Llama 5 out. And after spending Major League Baseball pitcher type salaries for AI researchers, they've probably now restructured their AI team at least 4 times in the last 6 months. You look at what's going on with Apple, right? They announced all these AI features for Siri in 2024, but it'll be probably 2026, and they're going to have to work with OpenAI or probably Google following this antitrust ruling to get those features out. So you are already seeing this, and over the weekend it came out that OpenAI has sort of pushed up their revenue forecast for 2030 by about $26 billion to $200 billion. But to get that revenue increase of $26 billion, they're going to have to burn $85 billion more in cash. So the data points are definitely there, but we're in this business to make money. So you have to go, all right, well, do the fundamentals matter right now? Or is it the fact you're going to get even more easy money? The 10-year yield's going down to 4%. And so this market, much like in 2021, will keep going up right up until it doesn't. And so I think you have to look at that. And NVIDIA missing on data center revenues. And you can say, yes, but the growth was so high and all this, but they missed. So that should give you another data point, and you throw on top of that Dell or Marvell, or the fact that Avago's got more ASIC revenues because companies want to cut their costs. Those all speak to the same narrative. So don't confuse the actual data with what the stock prices are doing.
Dan, I think, people who are believers, who are basically...
So let me just push back against Dan Niles for just a moment there. Okay, listen. In regards to NVIDIA, here's the deal. You can't draw too much of a conclusion from one quarter. You got to see a trend, right? You got to see a trend. If you see next quarter, they also missed data center revenue, or let's call it barely come in line. Ooh, okay, now you got a problem with NVIDIA. One quarter, next quarter, don't be surprised if data center revenue comes in and smashes for NVIDIA. Do not be surprised at all. So, you got to understand with NVIDIA, there's going to be a time when NVIDIA is going to be having really troubling numbers, but that's still like a year to year and a half out. And when I say troubling numbers, like almost any other company would take those numbers, but what it's going to be is it's going to be really slow growth rates. But that's still like a year to year and a half out, in my opinion. So, the death of NVIDIA and NVIDIA stock has been greatly exaggerated. Like I continue to say with NVIDIA, it's just range bound. And it's going to remain range bound for quite a while, in my opinion. It'll push when people are feeling real bullish around NVIDIA, right? Let's say they come out next quarter and data center revenue smashes. Stock goes 200-ish range. And when people go bearish over the next few years, the stock will go down to probably 125 or so. And so I just feel like the stock for years is going to be stuck in this 125 to 200-ish range, and it's just going to kind of be somewhere in there, and that's going to be for the next several years, in my opinion. And so, once again, people go bullish, going to push up to that 200 range. People feel bearish, going to push down to the 120, 125 range, and that's just going to be the game. And I think that's the game for the next several years with NVIDIA stock. And so that just is what it is.
Not committed to this whole CapEx story will say, well, sure, companies are not yet seeing the benefits, or they're not yet accelerating their adoption of various AI tools because we're not there yet. And we have to build as fast as we can to get there. The market's permitted a lot of these companies, the entire infrastructure trade, to go pretty far at this point. Is there any sign that the market's going to kind of tighten the reins on that?
Well, number one, I would disagree with your premise that, it's okay to not see returns. We're 3 years into this, Mike, right?
I didn't say it's okay. I'm suggesting the market's been okay with it.
Hold on, Dan Niles. We're not really 3 years into this, in all due respect. So this AI cycle started to take off at let's call it in 2023, right? So that's when you started seeing the first big orders of AI chips roll through, okay? So Then last year was a let's call it an uptick year, and this year's a further uptick year. Like, if you're on the side of trying to make money from AI, here's the deal. Like, you're way too early in the cycle to really be showing any meaningful returns yet, unless you're somebody like a Meta or maybe a Google, somebody like that that's already got it, or ChatGPT's seeing returns on obviously their investment and whatnot, right? But like, you're still too early in regards to like having to see a return right now. A lot of these software companies, like even a Salesforce, for instance, right? A lot of their big, let's call it, increases of revenue will come in 26, 27, 28, 29. Like, that's all still rolling down the road. Palantir's obviously started to see a very meaningful uptick in regards to their revenues. But it's a game that's got to play out. Like, to say it's 3 years, a little bit false in my opinion. We're more like a year and a half to 2 years into at least having an ability to start to generate some revenue from these chips you're buying and what that ends up producing at the end of the pie.
Well, but again, that kind of goes back to the fact that we're looking at rate cuts coming, right? That's been the number one driver of this market really since COVID, and you can argue since Lehman failed, right? So, you have inflation going from 1.4% to 2%. 1.4 to 7% in 2021. The S&P is up 27% because the Fed keeps telling us it's transitory when I think a lot of people, including myself, thought it wasn't. Then 2022, you admit to it, rate cut.
I got to push back against Dan Niles again. I love Dan Niles, but man, I got to push back against this. Hold your horses, Dan Niles. What he just said there was just preposterous, just ridiculous. The main driver of this market, since even Fannie has been rate cuts and rates. No, in all due respect, Dan Niles, it's been earnings. Same thing that since COVID. He spoke about COVID there. Since COVID, it's been the main drive. No, earnings. Have you seen what's look at Apple's earnings per share before 2020. Look at their earnings per share now. Look at Google's earnings per share before 2020. Look at Google's earnings per share now. Look at Meta's earnings per share before 2020. Look at their earnings per share now. Look at Nvidia's earnings per share before 2020. Look at it now. Look at Amazon's earnings per share before 2020. Look at it now. No, nothing about rate cuts. The driver of this market since Fannie Mae, Freddie Mac in 2008, 2009, and the driver of this market since Rona has been earnings. In all due respect, nothing about rate. That's irrelevant in the conversation, just to be quite frank. Irrelevant.
Hikes happen, the market gets beat up pretty good. 2023, the Fed goes ahead and goes on hold this year, and the market's obviously surges over 20% this year. Looks like rate cuts are coming. Market starts going up. And so that's doing a lot of this driving of it. And that's why it makes it seem like people are okay with this. Because don't forget, NVIDIA is down since they reported. Obviously, it surged a lot off the bottom, but don't forget, like middle of last year when Microsoft, Google, Amazon all had CapEx spending going up while the revenue estimates were actually getting cut. NVIDIA went flat, went sideways for the last half of last year. So, this is a point in time. The rate cut's in front of us. That's why if you see a lot of the things that I write, it's forget about valuations, forget about fundamentals. It's all about easy money. And the party's going to continue right up until it doesn't. My thought has been that's around Thanksgiving when, we find out there has been a big pull forward in demand. But in the near term, the goal is to make money, right? And then being intellectually right, that's something that ultimately will help you make money on the other side of this by being short a bunch of stocks. And I think we're getting closer to that. But for right now, it's stay long and make money.
So Dan Niles says, for now, stay long and make money.